Without further ado, I'd like to welcome our presenter today. We have Rodney Cabrera with Firstmark Credit Union.
Good morning, everyone. How's everybody doing? Awesome. I'm happy to be here, and I appreciate the invite and the opportunity to be a part of this event this Saturday morning. I first learned about the organization, I believe it was last May when we were part of we were at the home repair fair. I don't know if anybody here has been to one of those, but yeah, we were there and got great conversations, got to meet a lot of great folks there, and so I appreciate the opportunity to be here again. Thank you, Megan. Thank you, Lauren. I know Lauren's not here this morning, but I appreciate it. As Megan said, my name is Rodney Cabrera. I know this morning we're going to be talking about financing your rehab. We're going to be talking a little bit about home equity. You know, what can we do with home equity? We'll be discussing a few items there. And just a few things about me. Again, my name is Rodney Cabrera. I'm the manager of mortgage lending at Firstmark Credit Union. I've been at Firstmark since 2012. So actually, I believe next month will be my 14th year at Firstmark. Great career there. I've been specializing over the last 4 or 5 years in home equity, helping our members access smart, affordable financing, finding ways how we can leverage their equity for all their life events, not just home remodeling, home projects, but just in general, how we can help them with their life. Just a few personal things about me. I was raised here in San Antonio. Actually, I was born in Houston, but we got here when I was like 2 years old. So as far as I'm concerned, I've always lived here all my life. I'm a proud father of 5 daughters. So as you can imagine, I'm completely outnumbered at home. As a matter of fact, we have a cat. The cat is female as well, so no support there. I wouldn't have it any other way. As you can imagine, sometimes life is a little hectic with 5 daughters at home. But I can't complain. I'm very blessed. I wouldn't say have any favorites. Well, at least I wouldn't tell them that I have any favorites. But their ages range all the way from my oldest is 24 years old, and my youngest is 2 years old. So as I mentioned, I don't have any favorites, but that 2-year-old is starting to kind of edge them out a little bit. So she has me wrapped around her little pinky. But a little bit about Firstmark and the organization. Firstmark Credit Union, they were formerly known as San Antonio Teachers Credit Union. It's been quite a while now that we've had that name change, and we're now recognized as Firstmark. They were formed in 1932. We're member-owned, locally controlled, not-for-profit. Our common purpose is working together with our members to build their tomorrow. I don't know if anybody here is a part of a credit union or you know what credit unions are. Maybe you're part of a bank, but I encourage you, credit unions are quite different than banks. You know, especially us at Firstmark, we're very member-centric. You know, it's about the member. It's about being part of that journey. You know, it's much more than a credit score. We want to be there part of, you know, whatever is going on in life, whether you're buying your first car, you're buying your first home, you're planning for a wedding, you're refinancing your home, maybe you're upgrading, maybe you're downgrading. We want to be a part of that member journey throughout your life. So I encourage you, if you've never spoken to anybody at a credit union, go talk to someone at a credit union. I think you're going to see quite a bit of difference there. So today we're going to be talking, as we mentioned before, financing your rehab. We're going to be talking about different things today. First off, home equity. We'll discuss what is home equity, what can you do with your home equity, how can you leverage that for your projects. When is a home equity loan a good fit? We're going to be looking also at what are some of your options. There are different options when it comes to home equity. There isn't kind of a one-size-fits-all approach. There's actually different options for depending on what you got going on in life, and we'll discuss a few options. And then we'll talk a little bit about the application process. And when I say the application process, I'm not necessarily just, filling out an application. What does that process look like? There are a lot of rules in the state of Texas that you should be aware of, some waiting periods, who's eligible for a home equity loan. So we'll be discussing a little bit about that this morning as well. And then at the end, we'll open it up for some questions. And by the way, I love questions. So if you have a question that can't wait till the end and you want to ask, I'm all for it. So you don't worry about offending me if you have a question you want to ask. So starting off with understanding home equity. What is home equity? Home equity is the portion of your home's value that is actually yours, right? So I'll give you an example. If your home, your market value is $300,000 and it's completely paid for, you owe $0 on that home, right? There's no liens. Then you have $300,000 of equity in your home. Now, if you actually have a mortgage on your home, in that same $300,000 house, you owe $200,000, that's your balance on your mortgage, then we would subtract that from your value of your property, and you have $100,000 of equity, right? Makes sense, right? So it's that portion of your home that you owe no money on, and that would be your equity. Now the question is, what can you do with that equity, right? What can you do with that $100,000 or whatever that amount is for your particular situation? In the state of Texas, and a lot of these terms I'm going to be using this morning, or some of the information I'll provide you, it's not a Firstmark Credit Union rule. These are a lot of the Texas requirements. So when we talk about 80%, the state of Texas allows all consumers to access 80% of their equity. You cannot access 100%. You're allowed to access up to 80% of your home. So in this example, if we had a $400,000 home, 80% of that home would be $320,000. Now, in this example here, if we had a mortgage balance of $125,000, we would subtract that from the $320,000. And now in this scenario, we would have available $195,000. Does that make sense? In the scenario, if we didn't have any balance, then we would have $320,000 available to access in the state of Texas. Now, what are the benefits of using a home equity loan versus some of the other options, right? Because there's a lot of options when we're talking about financing your rehab, right? There's options. Good morning. There's options for, you could use your credit card. You could use personal loans. Some folks have even drawn money out of their 401k. So there's a lot of different things that folks would consider when, working on a big project at home. But there's some great benefits for using your equity. Number one, traditionally, there's much lower rates on a home equity loan, right? So if you want to use your credit card for a big project, you're probably aware that interest rates on credit cards are, north of 20%, sometimes 30%. That could be a very, very expensive project if you're considering using a credit card. I've also seen folks, again, if you're using some of those like payday lenders, or title loans, things like that, those rates tend to be very high too, with a lot of fees involved. So traditionally, again, with a home equity loan, you're going to see much lower rates. The other benefit of using your home equity is that you have access to larger loan amounts, right? So if you are interested in just a personal loan, a lot of lenders will kind of limit you to 1 times your monthly salary or 2 or 3 times your monthly salary. So you have a kind of a limited budget to work with if you have a big project going on. Also, when it comes to credit cards, you may not have enough, credit limit unless your plan is to max out several credit cards. Again, that could get a little concerning with all the interest that you're accruing on those credit cards. The other benefit is that traditionally you have longer repayment terms, right? On a personal loan, you're typically restricted to about 5 years and less. But on a home equity loan, you have options to go out all the way up to 20, 25 years. You could go as short as 5 years, 7 years, 10, 15, everything kind of in between, all the way up to 25 years. So that certainly allows you that flexibility to kind of extend that payment, and especially if you're needing a larger loan to take care of a big project. The other benefit of a home equity loan is you have a couple options. Again, there's options out there where you have a predictable payment, or a flexible payment. You could have a fixed payment that's due at the same time every single month for the next 10, 15, 20 years. Or there's options where you can choose to pay interest only and kind of draw that out until you enter a repayment period. And we'll touch a little bit more on what your options look like. And what I really love about home equity loans that a lot of folks don't realize is that it could be utilized for much more than just a home project. Folks don't realize that when it comes to home equity loan, there's many things you can do with that, and it's not just tied to your home improvements or home projects. There's a lot you can do with that. What are some of those things that you can do with a home equity loan? Of course, home improvements, which we're talking about today. You could also use it for debt consolidation. You could use it for educational costs, ongoing expenses, emergency funds, big purchases. And the neat thing about a home equity loan is you could use it for one of those items or for all of those items. You could mix and match. You could use, do all the above or just do 1 or 2 of those items. You've got a lot of things going on. You have a home project and you have some debt you want to consolidate. You could do those things. You're not just limited just to home improvements. As a matter of fact, big purchases. We've had members, I've been part of some conversations with members where, there was maybe they wanted to purchase the land right next to their property. It came available. and they were considering getting a land loan. You know, when you look at a land loan, you're looking at 20, 30% down, high interest, very low, short terms. It's kind of a high-risk loan for a lot of lenders, so it isn't a very inexpensive product to consider. But we've had members that have a home and have equity, and they just extract the equity to purchase the home, right? You know, the piece of land right next to their property. So there's different things and different scenarios that would apply that would be very beneficial to consider a home equity loan. And now it's stuck. And it doesn't, there it goes. All right. So what is actually a home equity loan? So when you apply for a home equity loan and you extract that equity from your home, you receive a lump sum, right? In the example we gave earlier, there was $195,000 of equity. If that borrower decided, you know what, I want the $195,000 with a home equity loan, you get access to that $195,000, one lump sum. You will have a fixed term. So if you had a 15-year, it's a fixed term for 15 years. That's not going to change unless you decide you want to pay it off early. You're going to have a fixed interest rate, and you're going to have a fixed payment. That's not going to change, okay? Some folks ask, is it possible that my payment could ever change in a home equity loan? Your interest rate in your principal amount is never going to change on a home equity loan. The exception to that, similar to a mortgage, has anybody here ever had a mortgage? I would assume so. When escrow, are y'all familiar with what escrow is? When your mortgage carries escrow, and that includes your taxes and your insurance. Unfortunately, what happens every year? Insurance doesn't necessarily go down. They tend to increase. Taxes often increases. So the only exception to the rule is if you were to include escrow on your home equity loan, then if your insurance increases, if your taxes increase, then your payment would be adjusted to ensure that there's plenty of funds there for your escrow. But your principal payment will never change. It'll be the exact same payment from day one all the way to year 15. It'll never change. Homeowners love this option for projects that have a clear scope and cost. So if you got a project and you know it's going to be X amount of dollars, you know it's going to be exactly $25,000 or a range of $25,000 to $30,000 for the new roof plus the walls you want to paint at home, or you know that your cabinets and the flooring that you want to replace, you have a kind of a clear understanding of what that's going to be, or the debt you want to consolidate, you have a good idea, great option for you. And the reason I say that's a great option is you don't want to extract more than what you really need. Because the moment you extract that $195,000 in that example I gave, you're paying interest on that entire amount. So if you have a clear amount in mind that you need for your project or the items that you want to take care of, this is a great option. And in additional uses beyond the home improvement, again, you could use it for debt consolidation, and you could still use it for major purchases. That's a great question. So in this scenario, on a home equity loan, whatever you apply for, whatever you're approved for, and let's just say it was $195,000, you're going to get that lump sum. Now, you're eligible for $195,000 doesn't mean you have to apply for $195,000. If you said, my project's only $50,000, I'm good with the $50,000, or I'm good with the $25,000, that's perfectly fine. You have more than enough equity in your home in that example. That's a great question. So I don't know if everybody heard the question. Number one, you were asking, in that example, if you have to take the entire loan amount, or right, the entire equity. You don't. So right, in the example I gave, we had $195,000 of available equity. Do we have to extract all of it? No. If you want to, you could, and you get that lump sum, but if you decide that for your project you only need 25 or you only need 50, then that's all you really need to extract, and that would be what the loan is for. And very quickly, the second part of his question is that going to be included in his mortgage payment? So this is a separate loan. If you already have a mortgage, you have a couple of options. You could either have a second loan as a home equity loan. Sometimes it's beneficial to refinance and pay off the old loan. So there's kind of two different scenarios you can go in with a home equity loan. Yes, ma'am.
I imagine you're going to talk about it later, but a line of credit, is this something similar you can set up? And I know you'll talk about it later.
You actually read my mind. That's the very next slide. So that's a great question and right on cue. So there's the other option to a home equity loan is a home equity line of credit, which we refer to as a HELOC, right? So it works very similar to a home equity loan. You still extract, same 80% value, all that still applies. The difference is that you don't get a lump sum. It's going to be a revolving line of credit. So in the example I gave of 195, now let's say I want access to the 195, but I don't necessarily want to pull the 195. You could actually apply for a line of credit, a HELOC, and have access to the 195. Now, you're going to borrow as needed, you'll repay it, and you could use it again. The great thing about a HELOC is that, well, there's two phases to a home equity line of credit, a HELOC. Unlike a home equity loan that's just, the 15-year or the 20-year term, it stays the same for the remainder of the loan. For a HELOC, you have a draw period, and then you're going to have a repayment period. So during that draw period, you can draw as many times as you want. There is a Texas rule that every time you get a draw, it must be a minimum of $4,000. So if you have a line of 195 and you got this year you want to take care of your roof and it's going to be $15,000, you can access the $15,000. And next year, if you have another project going on, you could access it again the following year or sooner if you need it. But yes, there is a line of credit. Now, some of the biggest differences between the HELOC and the home equity, other than the fact that you draw as needed, is that on a home equity, it's a fixed rate. And traditionally on a HELOC, it's a variable rate. So that's one thing to consider. And those adjust quarterly. And it's going to be, it could go up, it could go down, it could stay the same for years. There's no way of knowing what that's going to look like. So that's one thing to consider. I see a hand up there. Like to a traditional fixed home equity loan? So the question was, in case y'all didn't hear, can you convert it into a fixed loan? And the answer is, yes, you can. And the way you would do that is by refinancing it into a fixed loan. And so we could talk a little bit more about that as well. So you've had a HELOC, you've been using it, you got 5 years down the road, you took care of all your projects and you no longer have a need for your HELOC and you want to convert that, you have the option of reapplying and turning that over into a fixed home equity loan product. You certainly can. So this is going to be an ideal option when you have a long-term or phased project, right? So you don't have an exact amount in mind, but you know this, you're going to be needing access, ongoing access. This is the product that I think would benefit you the most. So maybe the rehab you're working on, this is going to be a few years, right? And you don't want to take it all, take care of it all at once on the first year. So as I mentioned before, maybe this is the year you want to take care of the roof and the foundation, and then next year you want to add the addition and you want to extend your porch, and you don't have an exact amount because maybe along the way you decide I want to give myself some flexibility and a cushion in case I want to upgrade. Maybe I want to buy the furniture that comes with my extended patio. Maybe I want to buy the bedroom furniture for the new addition that I'm going to be adding to the home. This is the option that allows you that flexibility to access more if you need it. But what I love about this is if you don't use it, you're not paying the interest on this option versus on the home equity loan. You already have that money in your account. You're paying interest on the full amount. So with this, you only access what you need when you need it, and you're only paying interest on what you utilize. Now, I mentioned during the draw period, and it's going to be 10 years. After 10 years, during those 10 years, the only thing that's due is interest only. That doesn't mean you can't pay any principal towards it, but it allows some flexibility to manage your budget. If all you need, the only obligation would be interest only. After you enter the repayment period, at that point, it will be principal and interest payments for the following 10 or 15 years to get you completely paid up. Additional uses beyond home improvements, again, you could still use it for debt consolidation. So if you kind of have a mix of both, you have a project that's not clear on how much you're going to need, but you need $20,000 to pay off some high-interest credit cards, you could certainly do that. If you have an emergency fund, a lot of folks use credit cards for emergency funds. AC goes out in July and you charge that credit card, pay 20, 25, 30% interest on an AC. That could get very expensive. This is a great option. You may not need it today, but next year AC goes out, you have access to that money for that AC. Yes, sir?
What are the interest rates today on a HELOC loan?
Yeah, I can give you some examples. They're probably going to be in the sixes. Now, when it comes to interest rates, even on home equity loans, it could be sixes, sevens. It's going to depend on how long of a term. So there's different factors. Of course, credit also plays a factor. And so do you want a 5-year term versus a 25-year term? That's going to vary. Yeah. Over here, and I'll come to you next.
If you did have $20,000 in credit card debt, though, would that kind of count against you and you're applying for a HELOC?
It's a great question. So the question was, will your credit card debt count against you? The great thing about working with a credit union, much more than a credit score, we want to see what's the journey, what's the path, how are we helping our members get on a better track. I'll tell you what, I've been part of a lot of conversations where we've helped members where it seemed like they were sure that this was just a Hail Mary. It was never going to happen. And so happy to be able to share with them that although they've had some, maybe some struggles, maybe some debt, maybe there's some credit cards, maybe they're maxed out, we see kind of down the road what we're doing is putting them in a better position. So if you have a HELOC or a home equity loan and you're paying off $20,000 of debt, and all of a sudden you take your $20,000 of credit cards and maybe those payments amount to $1,000 a month, but we refinance it into a home equity loan, and all of a sudden we cut your cost by $300 or $400 a month, we know that that's a benefit to you as our member. We know that it's going to open up your budget, allow you to save, allow you to do other things that will be productive for you and your family. It does. Do you mean having a loan? Right. What I'm trying to say, like with Firstmark, I'll give you that example, is traditional banks or traditional lenders might overlook someone with a 560 credit score. Maybe they had a few late payments. Maybe they're maxed out on their credit cards. Maybe there was an illness a couple years ago that unfortunately they got a little behind on bills. Sometimes traditional lenders will overlook that just because of the risk involved. When we're talking about a credit union, specifically Firstmark, we're trying to look past that one event and what's the future looking like? What have the recent 12 months look like? Maybe you had some issues 24 months ago, maybe 3 years ago, but over the last 12 months, you've worked hard to get on track, you're paying your bills, and so although your credit score is 560, that's not really reflecting your true attitude and your expectation and commitment to getting back on track. And so those are the folks that we love to work with. So again, not that credit score doesn't matter, because that can impact your rate, but that doesn't automatically mean that it's a no. It means that we're going to look in, we're going to ask some questions, but we certainly want to help you. And if it means giving you this loan helps you be in a better situation, decrease your monthly expenses, then we certainly want to be there for you. All right. So again, additional uses for home improvement is other than home improvement, the debt consolidation, emergent. Oh, I'm sorry, you had a question and I didn't get back to you.
Well, that's okay. I was just gonna ask, is the drop period in a HELOC always the same? Is it always 10 years?
So it is with Firstmark. So with Firstmark, we have a 10-year draw period. So you have 10 years to utilize that as often as you need, as many times as you need, and access whatever you need for your project. Yeah. Great question. And so emergency cushion instead of credit cards, cash flow for life events. I say cash flow for life events because we've seen situations where today maybe it's your home project, but next year there's a wedding you're planning for. Maybe you're going to be there's a quinceañera coming up, and that's going to be expensive. And so this is an option to help you with that. We've seen folks utilize home equity because every year they take a family vacation, and some families are accustomed to putting their Disney vacation on a credit card. That gets really expensive every single year. But if you got things that are ongoing and you typically use other means of credit, this is an option you might want to consider, again, because of the interest rates that are involved and the flexibility when it comes to accessing those funds. Giving you a payment example, right? So let's look at a home equity loan versus a HELOC. And this example, let's assume that you have a $100,000 loan. The interest rate on a home equity in this example would be 7.04. That's a fixed rate. On a HELOC, traditionally, it's going to be a little better than your traditional home equity loan. So your variable, it's going to be variable, and the rate would be 6.62 in this example. On a home equity loan, you're going to get that money all up front, and let's assume it's a 20-year term. You are going to begin paying principal and interest payments once you have get that loan and that loan is funded. For the next 20 years, your payment would be approximately $777.70. And that's not going to change. The only exception would be, of course, if you had escrow and something changed there. But other than that, yes, ma'am.
Are the interest rates something that you're just prime or the prime plus your margin?
So that's a great question. So we do have prime plus margin, but it's not always plus. Sometimes it's minus. So it does vary. So our rate is going to be very competitively priced based on what's going on in the market, and especially in the San Antonio area. So, but good question. It's based on prime. And in this example, it's 6.62. And whereas on the fixed product, on a home equity loan, this is going to be interest only during your draw period, as I mentioned before. In this example, it's still a 20-year loan, except it's broken down into two phases, 10-year draw, 10-year repayment. But your payment, once you enter that 10-year repayment, would be approximately $1,141.59. So as you can see, there's a difference there and allows for some flexibility, but you got to be aware that on one side, you might be extending your loan for 20 years, and on the other option, if you decide not to make any principal payments towards it, when it is due for your repayment period, you have 10 years. There's also a 15-year option to repay that. And so just something to consider and to kind of visualize what those payments kind of look like and how both of those products work. Any questions on that? Yes, sir.
Maybe I misunderstood. In the HELOC, you got a 10-year draw. You're not making payments?
The only thing due would be interest only. So he's asking if any payments are due during the draw period. Your obligation would be interest only payments with the option if you wanted to bring your balance down because you plan on reusing your line of credit, you could certainly do that. But your obligation would be interest only payments. Once you enter your repayment period, no more draws. You can no longer access your line of credit. It is closed, that access at least, and now you begin repaying your loan with principal and interest. If you've already, throughout the draw period, we're already making payments towards your principal, whatever the balance is, once you enter repayment, that's going to impact what you're going to be paying for principal and interest. I saw a hand over here, and then I'll come back to you.
Just real quick to confirm I heard you clearly, you do have the option to pay principal on a HELOC
Absolutely.
during the draw period if you choose. And that doesn't like trigger your repayment period to start any sooner than the 10-year draw period, right?
Great question. Right. So you have the option. So you extracted $25,000. You could just pay the interest, or you say, I want to knock this out in the next 12 months because I want to use it next year again. You can do that. It doesn't penalize you. No prepayment penalties. As a matter of fact, Texas does not allow prepayment penalties on home equity loans. And so that you won't be impacted there. And it does not trigger stopping your line of credit and entering into a repayment. So you still have access for the next 10 years to use it as you see fit. And hand over here. Great. Yeah, that's a great question. So sometimes yes, sometimes no. So depending, there's different approaches, and depending on the loan amount, depending on the loan to value. I mean, if we're maxing out and there's a discrepancy in the value, then we may recommend and we may require an appraisal, but it's not always required. Depending on the loan amount, and if there's no dispute on the loan amount, and you need access to $50,000, and the county appraisal district has your home valued at $300,000, we're all in agreement. There's many times where you just proceed with that value. So you won't. The great thing about that is that you're not incurring the cost of an appraisal, which if you've ever had to order an appraisal, that could be $500, $700, and that could also delay the process. So it's not always needed. Great question. Did I see another hand? Yes, ma'am. Options for people that have a reversed mortgage. Yeah, that's what I was thinking. You'd be in a situation to refinance and pay off that old balance. Because if I'm not mistaken, I don't know a lot about reverse mortgages, but I believe once you're in a reverse mortgages, you're kind of limited to what you can and can't do. What you would have to do is typically pay that off and get out of that agreement. So similar to another mortgage or another home equity loan, if you wanted to pay that one off, you could certainly do that and now not be obligated to the terms of that reverse mortgage. So if that balance is paid off, you're completely okay with stopping that reverse mortgage, and now you would have a new home equity loan where you could access your equity for your projects. Does that answer your question? Yes, yes, sir. The way you would do that is by reapplying for another home equity line of credit. Yes, and so example, maybe you applied and you had $25,000, and 5 years later, you're like, I'm really using this. I need more. I got a big project. I need access to more. Or I need to extend my period of the draw period. You would apply for another HELOC. We pay off the old one, cancel that one out, and start fresh. That would be an option. Yes, ma'am.
You mentioned the appraisal district. Do you mean that the home's value is based on a property tax value as opposed to market value, or a combination?
So great question. So if we go to like the Bexar County Appraisal District, there is a section that says market value. And so we would be based on that value most of the time, not all the time, depending on the loan amount, right? So if you need, a $200,000 loan on your home, and we're saying that your home is worth, $500,000, $600,000, once we start getting into higher loan amounts, we're going to probably be looking at appraisal. I'm sorry. So now, when we talk about appraisals, it's not always the same type of appraisal. We're accustomed to, when we talk about appraisals, someone goes out to your home and, taking pictures inside and out and, 14, 15-page report. Many times we need those, and sometimes there's kind of in-between appraisals, right? So sometimes we're in a position where, we don't need a complete, full appraisal that costs $600. Maybe we can do a hybrid appraisal. And we have hybrid appraisals that are $100 versus $600, $700. And so sometimes those meet our needs, and we're able to, from our underwriting standpoint, we're able to go with those hybrid appraisals. So it's not always a one-size-fits-all either for those appraisals. All right. Let's talk a little bit more about the home equity loan requirements. So in the state of Texas, once again, this is not a Firstmark rule. These are Texas requirements. Whether you decide to work with us or go to another institution, these rules are going to apply. So number one, for home equity, it must be your primary residence. It has to be your homestead. Okay, it can't be your secondary, it can't be your investment, can't be a rental. You have to be the owner, and it must be the primary residence. It also must be a Texas property. And that's important because every state has different rules. We talked about the 80% rule, which is the very next block. There are states where they allow you to access 90%. Some states allow you to access 100% of the equity in your home. In the state of Texas, we are restricted to 80%. The other rule is that you could only have one home equity or HELOC at a time. All right, so you can never have two at a time. If you have a mortgage, it's not a home equity. You can have your mortgage and have a home equity. But if you currently have a home equity, you cannot have both of them at the same time. One of them must be paid off. So, and you could do that through a home equity loan, just pay off the old balance, and now you're down to one. There's also a waiting period of 12 months. So if you had a home equity in the past, and it's been more than 12 months since you funded that home equity, you're okay. You could refinance and start over and get a new one. You don't have to, wait 20 years or anything like that, but you are required to wait 12 months. And you can't have a HELOC and a home equity. I know those are similar products, a little bit different, but you can't have both. It's one or the other. And so the mandatory waiting period, that is built into the application process. No matter where you go, in the state of Texas, if you decide you want to move forward with a home equity loan, the lender is required to give you a 12-day waiting period. We call it the cooling off period. And during the 12 days, what happens is that gives all consumers the flexibility, the time to go research. Make sure you're familiar with the terms, familiar with the estimate, familiar with the documentation that the lender has given you. If you wanted to shop, that gives you time to go shop. So Texas is very consumer protective and friendly. They want to make sure everybody has plenty of time to review the information. You feel good about putting your homes up for collateral for this type of loan. So at the very minimum, and this is important because, talking about the AC in July, your AC breaks today, I'm assuming you need that money right now. And so this is a great option. However, just be aware that unless you already have your line of credit open and it's ready to go, so you can just access it at any time, if you're applying, there is a 12-day mandatory waiting period. Now, at the very end, once we close your loan, there's another small waiting period built in that we have to afford to all consumers on a home equity loan. And it's a 3-day right of rescission. So today's Saturday. If I was sitting with you this morning and we were closing your home equity loan, unfortunately, I can't give you your money today. I have to allow you 3 additional business days to exercise your right to cancel. So in case you come back and say, Rodney, I changed my mind. I don't want to buy that piece of property next to my home after all. It got sold, or I don't need the money. Whatever the case is, I changed my mind. You don't even have to give me a reason. You have the right to rescind within those 3 business days. After those full 3 business days, you haven't said anything, you haven't exercised your right to cancel. At that point is when lenders are allowed to give you the funds for the home equity loan. So what are we looking at? Minimum 15 days, 16 days. So it's not a very quick turnaround process. Now, during those 12 days, we're not kind of sitting idly by just waiting for you to let us know if you want to proceed. During this time, what we're doing is getting everything ready for you. So if an appraisal is needed, we're ordering an appraisal. We're asking you for your homeowner's insurance, right? We're going to typically ask you for proof of homeowner's insurance. Income verification, right? We're probably going to ask you for pay stubs, a W-2 or 2. And so those are the things that we're getting ready for you so that once we're past the 12 days, we can take care of finalizing the loan for you. The other rule that's very important in the state of Texas is that every home equity closing must be at the lender's office, the title company's office, or the attorney's office. It cannot be remote. It cannot be over DocuSign. It can't be at your home. It can't be at Starbucks. Unfortunately, in the state of Texas, it has to be in one of these 3 locations. Firstmark has 12 locations across San Antonio, La Vernia, and New Braunfels. We're not going to charge you anything extra to do the closing at our location. So we will traditionally, unless you prefer otherwise, we're going to schedule your closing at one of our branches that's convenient for you, whether it's close to where you work or where you live. We'll do that. When we work with a title company or attorney's office, they don't do it for free. And traditionally, that's going to be a cost that's going to be passed on to the consumer. So where we can help it, we'll take care of it ourselves so that you don't incur any additional cost. Now, the application process itself, what does that look like? We talked about the waiting periods. So when you apply, how do you apply? Number one, and there's a flyer out there at the table, and I would encourage you to pick up a flyer. It actually has a QR code that's going to take you directly to our home equity site at Firstmark. But you can apply online, and let me tell you, that application process is about 5 minutes. It's a very, very quick process if you apply online. If you apply online, someone's going to reach out to you in case there's any questions, if you happen to miss anything, but it's a very quick process. But the other option is you can do it over the phone, or you could do it in person at one of our 12 locations. So very simple process there. Once you apply, the state of Texas, here's another Texas rule, it requires the lender to give you a decision within 3 business days. Now, at Firstmark, our expectation for our team is we're very excited. We like to share the good news as quickly as we can. So if you apply, we try to reach out to you within 24 hours. That's our expectation and what we want to do for our members. Now, today's Saturday. If you left today and you applied today, you're probably not going to hear from us today or tomorrow. But when we get in the office on Monday, you would be hearing from us on Monday. Now, we are, again, required to give you that decision, whether it's approved or whether it's declined or whether it's counteroffered. Whatever the case is, we have to give you a decision within 3 business days, and we must give you your early disclosures. So your early disclosures, that's where you're going to learn about what your term is, what you got approved for, what's going to be the loan amount, what's going to be the interest rate. We're going to give you all that information up front so that you can study that, review that, ask questions during those 12-day waiting period. Yes, ma'am. Great question. So the question, in case you don't hear, is: are counter offers is it kind of negotiation? Is it typically in the best interest of the credit union? Actually, no. I'm happy to report. Sometimes, based on income requirements, maybe you don't quite qualify for the $100,000, but we can say, based on your income and your debt to income, we can't get you the $100,000, but we got pretty close. We're at 75, right? So that would be a counteroffer. But I could also tell you, we've been in situations before where someone applies for $50,000 or $25,000, and the counteroffer isn't giving them less. The counteroffer is the path forward here would be to pay off some of this debt. You got a lot of high interest credit cards. It's eating away at all your monthly income. And because of that, those expenses every month, there's not enough left over for you to pay this loan for your project. However, if we increase your loan from 25 to 40, as an example, we can pay off the credit cards, eliminate that $600, $700 payment, and now that decreases your monthly obligation, and now that makes it more flexible for you to afford this loan. So it's not always a situation where when we think counteroffer, it's I didn't get what I wanted, right? I didn't get the amount that I applied for, and that's not always the case. Again, we want to look past, just the credit score or the debt to income. What can we do to help our member? And sometimes that's more than what they actually applied for to put them in a better spot. All right. And so once we provide you those disclosures, we've given your decision during those 12 days, we have a processor assigned that's going to be collecting the homeowner's insurance, ordering reports, ordering the appraisal if it's needed, doing a title search just to confirm that there are no clouded titles, making sure you're the owner. If there's any issues, we want to make you aware of them early on, especially if you weren't aware that there was an issue. And what kind of issues? What we commonly come across is when sometimes when parents maybe would have gifted a home to their children, when people pass, and maybe the owner of the home or the surviving spouse hasn't gone through the process of updating the owner of record. And so those are the things that we commonly see, and that doesn't mean it's a complete stop and we can't do anything about it. You know, we'll discuss that and at least let you know what can be done. We have attorneys that help us as well. Sometimes it's a matter of getting an affidavit, and if we can't do it, we can at least tell you what what steps you need to take so that you can correct the title so that we can move forward. Yes, ma'am. I think I heard you. You said how the parent giving their children the home, how does that impact them getting the credit or getting the loan? Okay. If they haven't transferred, for example, ownership, that would impact them. They wouldn't be eligible because they're not legally owners of the property yet. So that would be one example where they would need to correct that and get that ownership transferred so they can apply for a home equity loan. Because again, it must be your primary residence, and if it's still under the parent's name, they wouldn't be eligible. Not that I'm aware of. No, what we look at and what our title companies and when we do title searches, they're looking at the records, right? So if it's been recorded, if it's legitimate, they're the experts. They're the ones that are verifying the information, and if it's legitimate, then we're able to proceed. And they're the ones that will also let us know that, there might be an issue with ownership or title, a clouded title, and we'll be able to give you that information if you weren't aware of it. What could be contested would be is if they haven't finalized the transfer of ownership and now they're required to, maybe there was other possible errors, and there's a disagreement on who's the rightful owner, that could hold up the process because nothing has been recorded yet, nothing has been finalized. So that could be the case. Divorce is another common issue when someone is going through a divorce and they want to leave it to one spouse, or sometimes they're going there's some discrepancies there. There's a disagreement until it's in writing, until it's finalized, until things are recorded is when we're able to move forward. Yeah, and sometimes in those situations. If we can't resolve it or can't have our attorney resolve it, then we might refer you to someone else. It might be a lengthier process, especially if it requires other parties to get involved. Yes, sir. You could. You could. There is they call it a refinance, although you're not technically refinancing anything, but you could get a traditional 30-year mortgage and do a cash out, and so there are options for that. Now, is that the best option? Sometimes it is. Sometimes you might want to consider this option versus a traditional mortgage because of the fees and costs involved with getting a traditional mortgage. I'll give you the example, right? We talked about sometimes we need an appraisal, sometimes we don't. Traditionally, with mortgage companies, you're always going to need an appraisal. Traditionally, with a mortgage company, you're always going to need title insurance, which that alone could be $2,000, $3,000, just for that alone. And so there tends to be a little bit more flexibility and less cost when you're looking at a home equity option, at least within Firstmark. But certainly could be a good option if you need to extend it to 30 years. So let's say you need $500,000. You need extract a lot of money from the value of your property, and maybe you need that extra 5 years because that payment is much more comfortable for you. Because on a home equity loan, we could only extend it up to 25 years, or 20 or 25 years in some cases. But if you need those 30 years, then definitely a traditional mortgage could be beneficial for you. It could be, yeah, it could be. It really depending on your credit and how much you're extracting, but it could be, yes. Traditionally, it would be a little better on a traditional mortgage. It just you're maybe saving money over the long haul, or up front though. It's going to be a pretty expensive option to consider. Yes, ma'am.
What if you are over 30%, that, isn't that the golden ratio, like no more than 30% of your income should be going towards your mortgage, but if you're over that, let's say it's 50%, that's gotta affect, if not your credit score, then how the lending institution regards your application, right?
Sure. So we are required as a lender to show your ability to repay. And so, different lenders might have different, thresholds on what they're considering. 30% traditionally won't be an issue for us. It's not going to be as high as 50%. I know that was the other example you gave. But yeah, traditionally, it's going to be more than 30%. But every lender could be a little bit different. And even then, we look at ways, what can we do to bring that debt to income ratio down? Does it mean if we extend this for another 5 years, does that help because it's going to bring your payment down? Maybe that's the solution. Or the other example I gave of maybe we pay off some debt. That frees up some money, and so that could be a solution. So I would encourage you, if this is something that really interests you, this is something we could have a conversation on, especially with our team, because you might have the expectation, like in the example you gave, I'm over 30%. That's not the deal breaker. There are some other options we can look at and figure a path forward. Did I see another hand? I thought I saw another hand. Okay. All right. So processing, I talked about, we're getting everything ready. We're getting the documentation ready. And once we got everything ready, we're over the 12 days. We give you a call. We get you scheduled for closing at one of our nearest Firstmark branches. And as I mentioned before, we got a 3-day right of rescission that we have to wait. We're obligated to do that. Unfortunately, we just can't get past that. We have to wait 3 days to give you access to your funds. Yes, ma'am. Heritage restoration. If there's a loan specific to heritage restoration. Yeah, this could certainly be utilized for that. Now, other than, if there's grants given by the city or some other type of programs, occasionally there might be things available that the city might offer. But when it comes to historical preservation, if you have a big project, this is something you could certainly be utilized for that. Yeah, is there a loan that's specific for that type of property? Not that I'm aware of, other than, a traditional home equity loan or a HELOC. Yeah. I wanted to leave y'all with contact information with Firstmark. We'd love to help you. We'd love to be part of your journey, whether it's remodeling your home, whether you have a big project, an ongoing project, or just big life events coming along. You could always reach us at firstmarkcu.org. That's going to give you a lot of information, a lot of resources. As I mentioned, we have the flyer out there at the table that you can pick up. It has a QR code that's going to take you to our website as well. Our application line is 442-0199. Our folks there are going to be very friendly. They're going to be very educational, answer your questions. They could, if you have concerns about your debt, have concerns about, what you can really utilize it for. If you're not sure how much equity you have, they're equipped to help you understand that and dig a little bit deeper and find out how much equity you have available in your home. And as I mentioned, we got 12 locations across San Antonio, La Vernia, and New Braunfels. So, if you want to visit us in person, please do so. Our folks there are also knowledgeable and can help you. My business cards are also on the table, so if you want to reach out to me directly, my direct line is on there. Please give me a call. I'm happy to have a conversation with you. And with that, I know y'all did great with giving questions, but now officially, if you have any more questions, I'm glad to answer.
2 questions or 1 clarification and a question. With a HELOC, I could apply for it now, get that processed. But if I don't start a project for another year, I'm still not paying anything, correct? Or am I paying interest only?
Interest only, and the only requirement, remember, we have a minimum $4,000 draw. So at funding, let's say you had a $100,000 line of credit. At the beginning, if you don't need anything, at the very minimum, you're going to have $4,000, and you'd pay interest on the $4,000. So that is the requirement.
Thank you. And second question, origination fees.
So when it comes to origination fees, traditionally low. We don't have most lenders have like a 1% origination fee. So a $100,000 loan, automatically there's $1,000. Traditionally, our fees are going to be very much lower than that. Also, everything else, there's nothing tacked on other than what we have to pass on to you, right? So if appraisal is needed, we pass that on to you. Title searches, flood determinations, very minimal. We try to avoid any excess reporting, like I mentioned, like on the appraisals, if not needed. Title policy, that's another one that typically borrowers have to pay, and that could be, 1.3%. So on a $100,000 loan, you're paying $1,300. So those are the things we typically won't require unless we get past a certain threshold. Thank you. Great question.
As it regards a HELOC, are there situations where people will convert, like if they're if we're approaching a project over 3 years and we pull 60,000 for a HELOC and we want to convert some of those chunks as we pull them through the phases into a fixed rate something, is that?
No. So if I understand correctly, you want to take a portion of what you already owe and put it into a fixed product so that you're not paying interest on what you've already borrowed. There isn't a way, you would have to get a different loan, pay that off, so you're not paying interest on there, but now you're kind of paying, now you got two different products, assuming the other product is not a home equity loan, because once again, you can't have two home equity loans. So if you transferred, the money from a personal loan you took out and paid that off, I guess that would be a way to work around that. You would have to kind of weigh if it's really beneficial for you or not.
Okay. And then you mentioned flood. So we live in a 100-year floodplain. We've had a survey. Everything is above the BFE. So in terms of construction, that won't really provide us with an issue. But are there certain determinations that affect what we can do?
Great question. When it comes to flood, so we run a flood determination, depending on what product. If you have just a traditional home equity loan and you are in a flood zone, both products we are required to let you know that you are in a flood zone, if you didn't know already. And then we're going to be required, you have to provide us proof that you have flood insurance. Okay. And now on a home equity loan, we are required by Texas to escrow the cost of that flood insurance. Now, if you already have a mortgage and it's covered there, we don't have to do anything as long as we have proof. On the HELOC side, as long as we have proof, no escrow. We're not going to escrow that. You continue to pay that like you normally do. You just have to show us proof that you have the flood insurance. Good question. Any other questions?
I lied, I do have another.
That's okay.
Okay, with a HELOC, take that initial $4,000 draw as required. I can do whatever I want with that money, provided it's legal. So I could put it in an interest-bearing account and just hold on to it.
Whatever you'd like. Like you said, as long as it's legal. Whether you want to go on a trip, buy a piece of land, take your family to dinner at Fogo de Chao, whatever you want to do. It doesn't matter. You could take me too.
For the home equity loan, you said it needs to be your primary residence.
Yes, ma'am.
For a HELOC?
As well.
As well. Okay, thank you.
Yes, ma'am. And again, those are Texas rules. It must be. If you are ever in a situation where you have a rental property and you just don't have access to the equity on a primary residence, there are options. There are products out there. They're traditionally more risky in nature, so lender, typically rates are going to be a little bit higher. But there are things out there that can help you. But again, kind of thinking outside the box, if you already have a primary residence and working on a rental or a fixer-upper and you need access, sometimes those hard money loans, it's very expensive. You could access the equity in your primary residence, and especially if it's kind of an ongoing, you took care of one project today, have another one, perfect opportunity for that.
So my question, just to kind of tack onto his, so let's say you can do anything you want with that money. If you don't want to pay the interest on that, you could pay the $4,000 back to the HELOC.
You certainly could.
And then you could theoretically have a zero balance, zero interest until you really actually need the money.
You're absolutely right.
Okay.
Yep. Yes, sir. Yeah, and I guess another thing I should bring up, so that initial $4,000, so, he had a question about closing cost, And so you could roll those in as well, right? So if you had $300 or $400 worth of closing costs for the loan and you don't want to be out of pocket, you could technically roll that into the loan as well and use part of that $4,000. That counts towards the draw. So that's an option as well.
I just wanted to know if you had handouts or where we can get handouts of what you displayed, because it's a lot of info.
It is. I encourage you, we have a flyer out on the table in the back. My business card is there as well. There are some QR codes as well. I encourage you to go on our website. Give me a call if you want to have a more in-depth conversation. But you're right, it is a lot of information. We're happy to help you over at Firstmark, so just please give us a call.
I will add, we are recording this session, so we do plan on posting it online. Once I find out where the location will be, I believe we have everyone's email here when you registered for the event. If you don't, feel free to leave that with us, and then we can just send a follow-up email to everybody where that will live online.
And then both of them had, yeah.
I just wanted to ask a question. This might be obvious. Do you already need to be a Firstmark customer in order to apply for the HELOC and the other products?
That's a great question. So you don't need to be a member today. Now, once you apply, we are going to work on making you, helping you establish membership with Firstmark. What that looks like is opening up a savings account. And so you're officially a member with Firstmark. And so we hope that we can help you with a lot more than just home equity. We, whether, again, home equity, whether you're looking at a vehicle, whether you're looking at checking products, there's a whole lot that we do, and you could certainly see that on our website. But we will help you establish membership. And okay.
I'm representing the seniors in our family.
Okay.
So one aunt passed away and she left the house to two different individuals.
Okay.
If they want to get a loan to repair the house, only one of them is living in the house. How does that work?
So as long as one of the owners is living in the home, because that's a requirement. Now, being in the state of Texas, all owners or their spouses must be involved in the process. Now, that doesn't necessarily mean they're borrowers, but they must be made aware, and there are certain documentation we must provide them because they need to be made aware that there's going to be a lien on the property, and they also have to be at closing. So those are things to kind of keep in mind. So all owners and spouses need to be involved.
Okay, now my second question is, we have a senior. She already left she's leaving the house to another family member. They both live in the house, but the one that she's leaving the house to is not on the deed yet. It's a transfer of deed. How would that work?
Once they finalize the transfer of deed, at that point, she is the owner of record, and if that's her homestead, that's her primary residence, she would be eligible to apply for a home equity. Yes.
And
But
there's nothing else that we could do to start the process of the loan if the deed is not transferred over, correct?
So my recommendation is if you're in the process of doing that now and it's something you feel that's going to be done in the very, next 30 days or so, you could start the process to kind of get ahead. Now, if there's any issues or you feel that this is going to be a drawn out process, 60 days, 90 days or further, then I would encourage you to get all of that finalized so that we can expedite your process as quickly as we could. Because that could delay it. We'd kind of be in a holding pattern for quite a while, and what will happen after a certain amount of time, we're obligated to recheck documentation again, ask you for updated pay stubs. Sometimes you have to repull credit. If it's been 3 months or 4 months, again, we got to make sure that you haven't incurred any additional debt. So if you feel it's something that's going to be wrapped up very quickly, let's get started. If it's something that's going to take a while, then you may want to hold off for just a moment.
Thank you.
You're welcome. Some questions over there.
So aside from rates, as well as the amount of a HELOC that might be granted by an institution, what might be different from lender to lender, since so much of the rules are standardized by the state?
The cost and fees is really going to be the big difference. When it comes to rates, everybody tries to do a great job with, being competitive rates, and you're not going to see much of a big difference when it comes to rates. But you're going to see a difference when it comes to the fees that are involved, Also, the turnaround time. You know, we like to pride ourselves in, you know, doing home equities in under 30 days. That's our hope. Now, typically, that could be delayed if, again, title issues, right? We're waiting on something to be finalized. Someone's going through a divorce. Someone has passed. That could delay the process. But, you know, we try to get things wrapped up as soon as we're past the waiting periods that were required. So that's going to be another thing. We've talked to folks that have had experiences with other lenders, and sometimes they're looking at 45 days, 60 days, and that could be a very long time, especially if you have a project you need to get started on. So that's going to be, I think, some of the biggest differences you're going to notice. And really our communication, I mean, you know, keeping you up to date, up to speed with everything that's going on every step of the way. Yes, ma'am. So the question was, what are the prerequisites to apply for a loan? So other than the ones we've already discussed, being your primary residence, 80%, you know, being the owner, all that. When it comes to like employment, what we typically look at is stability in employment. So at least 2 years, or at least 2 years in the same field. So you said you just started a new job. I'll give you an example. If you were, you know, an accountant, you know, for 10 years at one place and you just started a new job somewhere else, but you're still an accountant, we can work with that. You're still kind of in the same field. So moving to a new job, if it's kind of similar or the same type of work, that doesn't disqualify you if it hasn't been at least 2 years. But yeah, traditionally, we're going to be looking at least 2 years of stable income. Other than that, when it comes to the proof, we're going to look at W-2s or pay stubs. If you're self-employed, we're going to ask for tax returns, so we can take a look at that, profit and loss statements. Does that answer your question? Okay. Any other questions? All right. If there are no questions, I'd like to thank everyone. I appreciate the opportunity to be here and speak with y'all. I'll be out there. I'll be around for a moment, so if you have any questions, if you want to walk up and say hello and have anything to ask, I'm happy to stick around and answer any additional questions. Thank you.